Testing 1 2 3. Hey, hi, good evening all. Mic test 1 2 3. Can anyone see my screen and as well as hear me? So just do appreciate that. Just give a shout out over at the chat box over there so that we could proceed pretty soon. Yeah. Hello everyone. Test. Good. Excellent. So how about my screen? The screen that's showing, can the Singapore stock market bull revive in Q3? Great, excellent. So we'll start in about a minute time. So just not to delay. So yeah, so just sit back and relax for a while now. Yeah. Okay, so let's get started. Now is 7:02 p.m. So very good evening, ladies and gentlemen. Thank you for joining me today in our webinar. So this particular webinar will be pretty much focused on the Singapore stock market as shown on my screen over here. So before I start over here is okay, so let's get started. So I believe that sound check, everything's fine. The screen, you guys can see the screen, yeah? Okay, so let's get started over here. So let me turn my camera off. Okay, so before we start, let's take a look at the disclaimer slides first. All right. Okay, so before I go into the proper we call it the agenda of this webinar, I'm just bear in mind over here is that whatever I share with you all is purely for education purpose, not kind of a direct advisory. Okay, so and the time horizon that I'm sharing you all is 3 months. Okay, they're about 3 months. Q3. I'm not talking about 1 year or 2 year down the road. It's about long term. We call it forecast of the long term view on the Singapore stock market. So I just want to make ourselves pretty clear. The time horizon is 3 months, which is this quarter Q3. All right. Great. So before we start, I'll give a brief introduction about myself. So those who actually heard of me, who am I? So just bear me for a while. I'm Kelvin Wong, the market analyst for CMC Singapore. So I've been in this market for close to 14 years, yeah. So starting as a junior economist as my first professional job. So then thereafter I started into trading the markets, looking at things from a more practical perspective, and also starts to picking up we call it intermarket analysis and as well as technical analysis skill. So right now, given my experience, my primary tool to actually look at the market or trade the market is firstly come from technical analysis first, followed by fund flows, intermarket, and fundamentals will be the last. Why? Because as you all know that markets are, there are two components that drive prices in the financial markets. One will be irrational behavior and rational behavior. Okay, so irrational behavior cannot be detected or cannot be what I call properly analyzed using purely fundamentals. All right, so you need to understand what's the liquidity that's driving the market at the moment, what is the fund flow that's driving the moment, and whether this fund flow and this liquidity and the sentiment is being overstretched or understretched. Okay, so how to actually analyze all this? So I understand it's a big word to digest, but not to worry. Later I'll share with you, right, there are actually two ways that you can actually learn about technical analysis. Is going to our CMC Singapore YouTube channel, where I actually right now I have this Trade the Markets Like a Pro, a series of education videos. So my aim is to produce 12 in all, starting from basic to intermediate. Starting from the very basic, what is technical analysis, how to use practical technical analysis to trade. So that I'll show you where to find this video. So at this moment, there are 10 of such short videos. Okay, uh, I try to make it as short as possible, but you know that if it's too short, is the quality will get deteriorate because there's no much quality or quantity. So the video is about average length between 10 to 12 minutes. Then for those who actually want to find out more about market updates, so I tweeted almost every day on my Twitter handle. That I'll show you how to find me and follow me. Okay, so this is how I believe that together with this kind of monthly webinar, we hope over at CMC to actually help our clientele to actually know more about the markets and to actually understand how the market actually moves. Okay, all right. So now let's get started. So before we jump into the STI, okay, the STI market. So let's take a quick look. Okay, for Q&A question, I will actually answer them towards the end, okay, to make it much more easier, so as not to interrupt the session. All right, so not to worry, I'll answer all the Q&A. Okay, so let's look at this performance table, okay, as of 16th of July, which is last week, last Friday, Q1, Q2, and year to date. So if you look at over here, starting from the S&P of the US market, the S&P 500, the Nasdaq 100, the Dow Jones Industrial Average, the Russell 2000, which is the small caps stock in US, like where actually it has your GameStop, your AMC is all inside here. So you could see that over here is that Q1, Q2. So Q2 over here is still pretty much positive. But what's interesting over here is the Dow Jones and the Russell starts to actually turn negative, not say turn negative, the returns start to get lesser versus Q1. Right, you can see. So the returns that's increased over here will be your Nasdaq 100 and your S&P. The increase the most is the Nasdaq 100. All right, 11% versus 3%. So what you could see over here is that towards the end of Q2, there was actually an outperformance of big tech stocks over cyclical, which is the Dow Jones Industrial, heavily weighted towards cyclicals, and the small cap stocks. All right, so this is what it means. Over here, you can see the shift of the performance. Then this is the year to date. Year to date, all of them are almost the same. All right, except for the Russell 2000, it gets much lesser, below 10%, 9%, because due to the underperformance of it in Q2. Okay, so now Hang Seng and Hang Seng Tech. So as you all know, that Hang Seng Tech and Hang Seng and Hang Seng Tech are actually pretty heavy weighted towards China big tech stocks. So as you all know, that the biggest weight in Hang Seng index is the Tencent. All right, so you could see actually over here is that pretty lackluster movement in Q2 because due to the regulatory clampdown. So the one that is facing the worst among all the rest of the world is Hang Seng Tech, definitely, because of this ongoing regulatory overhang, okay, that is imposed by the Chinese government on big tech stock, because we do not know when will it end. So that actually impacted the fund flows in a way. All right, so year to date negative 9%. End of Q2 not so drastic, it's almost unchanged. Okay, so this one year to date, why is it? Because Q2 ended in June, right? End of June, right? So year to date is take into account of now we're only heading towards the coming close to the first month of the Q3 is about to end sooner. So because that's what I explained, the last 2 weeks there was a kind of a more drastic decline on the Hang Seng Tech. All right, so Nikkei 225, nothing, pretty much it's about lackluster. It's a big sideways range formation. So German DAX over here is Q2 also, the performance also starts to come down pretty slightly, pretty drastically, almost half from the first Q1 performance, or in fact more than half. All right, so what you could see over here is that the German DAX zone is heavily weighted towards cyclical. All right, so it's very similar what to see in the Dow Jones Industrial Average. So for the ASX 200, it jumped by a fair bit in Q2. All right, then year to date 11.5%. So now this is the STI. So if you look at the STI, right, Q1 was very strong. Why? Because of the banks. The three banks, DBS, UOB, OCBC, actually made up close to 40% of the STI, and they are actually leading one of the, I would say, the outperformance in STI, which is part of the cyclical play, because you know that banks are cyclical. But however, in Q2, the reversal took shape. Okay, negative 1% in Q2. Okay, so what we could see over here, right, the difference, right, is that those index that are heavily weighted towards cyclicals tend to actually underperform, with the exception of ASX 200, because ASX 200 is weighted by the banks as well, and also some commodity related stocks. Only with the exception of ASX 200 that is still kind of holding the fort. Okay, so then for the bottom right, this what I did over here is I just normalize it by US dollar to make it basically, if you look at the STI, the ASX 200, all these are kind of a return, but return denominated by their local currency. That means if you are talking about really, if you want to really compare percentage return, I got to normalize everything to the same currency, because this US, what S&P is US currency, Nasdaq 100 USD. Hang Seng no problem, because Hang Seng is the Hong Kong dollar, and the US dollar is pegged, it's a fixed peg. So that's why you can look at a raw situation by using Hang Seng index, Hang Seng index. I can do a direct comparison because there's no currency conversion or something. So to reduce the currency conversion or normalize it, we can look at the MSCI ETF listed on the US stock exchange. All right, this is the Europe one, so everything will be in US dollar. Okay, so we could see over here is it's about the same, give or take. So I want to highlight one of Singapore. So Singapore, right, is also negative 0.77, but if you convert to currency conversion, right, it's slightly below. All right. So if you look at it, the situation over here, that the Singapore market actually underperformed in Q2. All right. So now the big question over here is that what will happen in Q3? All right. So I think this is most of the investors or traders that are trading the Singapore market are concerned about. Okay. So now let's take a look immediately. If I break down the 5-year performance, okay, take a step back since 2017. So these are our regional index, regional. All right, 5-year performance regional as at 16th of July. The top is actually TAIEX, close to 100% return. Okay, then you have Nifty, 86%, Kospi 73, Nikkei 225, 70%. CSI 300 is what I call the Shanghai and Shenzhen listed stocks listed in Shanghai and Shenzhen, the top 300 A shares, pure A shares, 55%. Then you have Hang Seng Index, 29%. Your STI, pretty lackluster, because if you look at the past 5 years, this is a rolling 5-year. That means it rolls every day as the days goes by. So this one, it rolls from start of 16 July. So if you plot it again the next couple of weeks or today, the values will change because it's rolling. All right. So, but it's a 5-year, it's just a look back 5-year period. All right. So what we see, the STI is 7% or 8%. The pretty similar to in terms of economy. The movement is the SET Thailand at 5.5%, and our neighbor KLCI, the FBI KLCI Composite Index, Malaysia stock market, negative 8%. All right. So what we could see over here, right? The leading one is Taiwan, India, South Korea, Japan, CSI. But however, if you look at the Southeast Asia is actually lagging. Okay, Singapore, Thailand, and KLCI. All right. So now, if I'll break down year to date, so you could see that the year to date over here is also pretty bad for the Singapore stock market. All right. Not say pretty bad, okay, it's better, pardon me, it's better. So if you break down to year to date, right, we actually rank the third, 10%. But the top, it still remains the top two, based on 5-year performance, the last 5 performance since as of August 16, July. Year to date, they also appear the top two, TAIEX and Nifty. So very obvious that TAIEX is actually driven by technology stocks, okay, and also that the technology stocks in TAIEX, right, is actually the semiconductor manufacturer, the OEM manufacturer that supply their parts to US big tech firm like Apple. All right, so if you look at it over here, the fortunes of TAIEX, right, is actually pretty much tied to the Nasdaq 100. Okay, if you look at if you do the correlation, so they're actually outperforming right now. In fact, very strongly in Q3. all right, at the moment in time, due to the strong performance of tech stock over cyclicals, which I explained earlier on in my Q3 outlook. Why are they outperforming at this point in time? And I still believe that the persistency of outperformance of tech stocks will actually last until maybe towards the end of Q3. Then from there we start to see the cyclical rotation again. So similar for Kospi as well, a tech Kospi. There you have Thailand 7%, Nikkei 225 since the start of this year, hitting the 31-year high in February. It's still a trade big sideways. Then you have the Hang Seng, definitely is over here, and the CSI 300, kind of pretty much clamped down by ongoing regulatory concern, especially on the China big tech stock. Then for the China CSI is that since the start of, I would say that right after Chinese New Year, Lunar Chinese New Year, around middle of February, the regulators right now are pretty much concerned about a bubble that's being formed in their local stock market, and they do not want to have kind of rampant speculative activity. But do keep a close watch on the situation right now in China, because liquidity seems to be increasing because of the RRR cut and to the reserve requirement cut. And tomorrow, I believe that there will be a announcement of their 1-year loan prime rate. Okay, so it seems to me that the authorities right now in China, or the economic planners in China, seems to be loosening a bit of their screws. That means shifting from a cautionary stance to a more relaxed stance to actually to be more slightly pro growth. All right, given the current situation that's happening globally due to the spread of this, or increased spread of COVID-19 mutated virus, the Delta variant, that could actually dampen economic growth from the demand side of the story. All right. So yeah, so pretty interesting for the China. So I believe that China CSI perhaps something we to watch out in the coming weeks to see the situation in terms of the liquidity situation in China. Yeah, then KLCI will be negative 5%, also due to the number one, the demand situation in Malaysia, where you start to see cases of infection increasing rapidly, and unfortunately, after various lockdown measures, it doesn't seem to help much. All right, now valuation. Okay, so when I talk about valuation, right? So a lot of people say that, hey, this is for child. Okay, this is not. Okay, so what I did is I get it from Bloomberg. So Bloomberg is able to get forecast. It's a great forecast by analysts as a whole in the component stock of all this. So it's a 12-month forward price to earnings ratio, not the current PE ratio, but 12-month forward. That means talking about consensus earning estimate going forward. All right. So if you look at it over here, right, based on Bloomberg Compile, you see our STI, right, is at 14 times PE ratio. All right. Below the S&P 500, which is 22 times, the Nifty 21 times, Nikkei 225 18 times, and even slightly below Taiwan and CSI 300. Okay, so if you look at the valuation of STI, right, it's definitely relatively cheaper compared to the SPX, which is the S&P 500, the US stock market in general. Then even the Nikkei 225, the Nifty, the India stock market, this is the benchmark for the India stock market, Nifty. All right, then the one that is more cheaper will be definitely KLCI and Hang Seng. Okay, and very interestingly, Kospi is the cheapest. Despite Kospi right now is in terms of the movement of the momentum, the price movement is one of the top performer. But in terms of earnings price for 12-month forward price to earnings ratio, it's pretty it's 11%. All right, so it seems to me that it's kind of relatively cheap. Or what we could see over here is earnings upgrade over here is pretty rapid in Kospi. That's why that caused the P ratio to come down. All right, so now what we could see over here is, yeah, we know that STI is relatively cheap compared to the S&P 500. Then a lot of people say, hey, since STI is pretty cheap, who knows what if STI could actually make new all-time high pretty soon because it's cheap, right? But the funny thing about valuation over here, valuation takes time to actually evolve. All right, so in terms of if you look at things in some perspective over here, is the strange thing about markets, especially if you're talking about from a shorter term perspective, like weekly, monthly, quarterly, okay, rather than yearly. We're talking about yearly as in we're talking about 3 years, 5 years down the road, or even 1 year down the road. Valuation over here, right, the valuation factor, right, to drive prices forward, right, especially on the shorter term, seems to be very less sensitive. All right, because at the end of the day, right, in the shorter term, I need to understand two things: intermarket correlation or relationship, momentum, as well as timing. So these are other factors to consider, right, when I'm looking at a shorter term perspective. That means we're talking about 1 month to 3 months. And this intermarket correlation and momentum and timing has a higher sensitivity if you start to look at much shorter term. We talk about a weekly approach, multi-week or even multi-day. Then with those talking about intraday, definitely you got to start to look at other things like order flow, order book. That means you're talking about the order, the bid offer orders that's being stacked in various stock. So that's intraday trading. So the things over here is that valuation, the sensitivity of valuation, right, or the magnitude that valuation plays in determining future price movement of any particular financial asset or stock, right, it will get lesser if I want to actually have a shorter term horizon to realize my potential returns. All right. So in order to actually to have a shorter horizon potential return, that means my time frame is much more short compared to 3 years or 5 years. I need to consider other factors: intermarket correlation, momentum, and timing, rather than purely just relying on 12-month forward price to earning ratio. That's saying that, oh, STI is relatively cheap compared to the S&P 500, where potentially STI could actually go up. Okay. All right, good. So now, if I were to right now, let's take a look at what is the intermarket correlation that I'm talking about. All right. So what I did over here, right, is you all know that the okay. So how do I start? Where do I start looking at intermarket correlation? Is we got to understand, right, what is playing out in the market in the last couple of months. All right, the team play that is especially reported in the media. Why? Because once it's reported in the media, you and I know, everybody knows. So in terms of getting outperformance or alpha, I need to know something that is not being fully reflected in the media yet. Clear? Right? So let's say if I open up the Straits Times or the Bloomberg, not say media is not good, media is good, general knowledge, but when it comes to investing or trading, we always got to be forward looking, all right, rather than backward looking or what's happening in the market. What's happening in the market, yeah, will give you maybe passive return, not say decent return, but it will not give you superior return, or we call it the alpha, the potential alpha that we want to seek to beat the benchmark. So to actually obtain potential alpha or superior return, I need to understand what is not being priced into the market or what not is being reported in the media. All right. So if you go back in time, especially around early Q2 to Q1, the media we have been talking about this reopening of trades, reopening economy. That means talking about, hey, the vaccine is here. We have fiscal stimulus coupled with very relaxed monetary policy that is still, in general, interest rate is still very low. We will start to drive economic recovery because everybody is opening up. Agree? Then this lead to the cyclicals to actually outperform. We are talking about the energy, the industrial, and the banks. Okay, so in order to see their outperformance, they're actually being led by this US Treasury 10-year and 2-year yield curve spread. All right. So it's actually the difference between the 10 and 2-year. Okay. So I give an example. If you look at this, since somewhere around this point in time, August 27, early 2017, all the way down to December 2019, this Treasury yield curve, the 10-year minus the 2-year, is actually sloping downwards. Can you see? Sloping downwards. So right now, the key thing is, since the start, especially in Q1 over here, where it actually broke out the resistance at around 0.72%. It broke out from this resistance here. So when it broke out from this resistance, if you realize that the rally of the bank, the industrial, and the energy and the materials also move in line. Okay, it moved in line, pretty strongly. So Then if you look at this red line here, starts to decline. March, April, it declined. Yeah? So really that when it starts to decline, and it decline further, you realize that it actually lead the performance of the energy stock, the industrial, the banks over here. Energy at that point in time haven't declined. So if you look at the last, what is as at 24th of June. So if you look at 2 weeks ago, energy stock actually came back down, went back down. So this is actually something like a leading indicator once it starts to slope downwards. All right. So what it means that the 10-year yield, the yield on the 10-year is lesser than the 2-year, which actually represent, right, it tells us that economic growth is getting lesser as being priced by the market, the bond market. So these are what I call government bond market. Why are you US Treasury? Because US Treasury is still the US is still the global benchmark market that have what I call potential spillover effect to the rest of the world. Okay, so now if you look at it technically, right, the MACD of this 10-year, 2-year is also downward sloping, indicating a bearish trend. Okay, so right now, right, we got to understand that this downward moving sloping curve here is having an impact on the cyclical, the industrial, the bank, and the material, the cyclical stock. So that explains their persistency of underperformance in the last 1 month or so. All right. So now, when will this underperformance end? All right. So then I got to look at, is there any sign this thing is about to reverse upwards? All right. So now let's go to here. Okay. So if I were to plot this 10-year, 2-year curve with our 3 banks, DBS, UOB, and OCBC, you notice that similar as well, the 10-year, 2-year start to slope downwards in March, April. Then after a couple of months later, about 3 months, around here. This is slightly later, around 2 months later, your OCBC, your DBS, your UOB, and OCBC starts to turn downward as well. All right. And now the key thing over here is this. Your MACD going to slope downwards and about to break zero. That means indicating to us very clearly this downtrend is pretty entrenched on the 10-year, 2-year. Then there's no sign of reversal yet. Okay, reversal as in something at this point in time where you start to see a bullish divergence, higher low, lower low. At this point, no, it's just momentum on the downside keep increasing on the 10-year minus 2-year. So what it means, if this 10-year and 2-year keep sloping downwards, coming downwards without any sign of reversal, it could potentially add further pressure on the cyclicals, which i.e. it were to add further pressure on the 3 banks, DBS, UOB, and OCBC. Agree? And in terms of timing wise and momentum wise, the reversal, there's no signs of bullish reversal yet, as indicated by the MACD of the US Treasury 10-year minus 2-year, the spread. So this is how I do it. I look at intercorrelation first. No, I look at the media report. I look at intercorrelation. And from the intercorrelation, I look at momentum and timing. Okay, so it indicates to us that, hey, DBS, UOB, OCBC, there's a risk that they may fall further due to the intercorrelation with the US 10-year, 2 years yield curve spread. Yes, it's coming down. Will it come down further? The probability seems to be higher at this juncture. Why? Because momentum, downside momentum hasn't reversed yet, as indicated by the MACD. So far, so good, clear? Now, why DBS, UOB, OCBC is so important on our STI? Because of this. If I look at the component weightage, I add them together, it gives them 40% out of the 30 component stock in STI. That means more than a third, That means their weightage is 40% inside STI. So what it means that over here, if STI, the chance of STI going up got to see further movement of DBS, UOB, and OCBC, higher chances of pushing up rather than the rest of the component stock, because the 3 of them is 40%. All right, and 3 of them, most of the time, they don't diverge in their movement. Yes, maybe diverge, maybe intra-hour or intra-day. But if you look at a longer term perspective, from a weekly perspective, from money perspective, their returns are almost similar, perfectly correlated, I would say. Okay, so since the first particular analysis we done that, okay, DBS, UOB, OCBC may face further under pressure from the yield curve compression, that means i.e. the chances of STI outperforming in Q3 seems to be pretty slim. All right, got that? So now if I do the technical analysis chart of the STI, okay, this is the weekly chart STI. So you look at STI, right, since the all-time high in October 2007, that means that's prior to the great financial crisis, 3,906, that's the all-time high. Ever since then, that means we're talking about close to donkey 14 years or 13 years, give or take. We are in a sideways range. Some of you can say, oh, it can be a symmetrical triangle, possible. We are talking about connecting the highs to here, connecting the higher low to here. So this could be a symmetrical triangle. So it's still ranging. Okay, it's still ranging. Now, I look at the current momentum. Okay, we all know that this is the, okay, so everyone, okay, so we talk about trend analysis. So from a long-term circular trend, STI, multi-year, I'm talking about multi-year, more than, I think that's more than 3 to 5 years, okay, 3 years and above, circular trend is in a sideways trend. All right, then now there is a trend that is within this long-term cyclical trend, long-term sideways is inching upwards, higher high, higher low. So this is a yearly trend, right? This yearly trend I consider as a major trend. So right now there is a potential major uptrend in place ever since the low of March 2020 at 2000 to 08. Okay, then from here, I know that this price is going upwards. Okay, now I were to let me bring down correspondingly to the momentum, this current momentum of this major uptrend as indicated by the RSI, relative strength index, a measure of momentum. You look at your RSI right now, it's coming to a resistance level at the overbought corresponding resistance in terms of the price section. All right, every time it hit this 74% level, if I correlate to the price section, it seems to me that there's a headlock impression that price tumbled. All right, every time it hit the resistance at this 74%, which i.e. that means it's telling us that hey, the STI may start to fall from or do a setback from here at this point in time. And how do I know that the chance of fall will be there is by the break of this corresponding support line that connects the higher low on the RSI. It break down. Recently, it does a bearish breakout. This was 19th of July. All right. So what it means that momentum rate of change has started to turn negative. Whilst price action, it still didn't show any signs, but it starts the leading indicator in terms of momentum. Okay, momentum always lead because of the mathematical, it's a second derivative. Anything that is a second derivative has a leading property over pure price action. This is what it means. So very simple is that if you want to do fundamental analysis, always get the second derivative of the fundamental data. Like PMI, you look at the PMI change rather than the raw PMI data. All right, clear? So now 3285 is a long-term pivotal resistance that I set for this quarter, Q3. If this level didn't break, we potentially could see the STI do a setback. That means there's about close to about 5 to 8% setback to test this support level here, which is correspond to the last swing high, and 28,030, which is also the graphical ascending trend line linking the current higher low that was formed from the March low over here, 28,030. All right, so potentially we could see a bit of setback within this major uptrend. That means i.e. what it means that over here is the STI is likely to actually underperform versus the rest of its peers. Okay, due to its technical configuration. And why does it like this? Why it formed this way? Because of the heavy weightage by the top 3 banks. All right, and also we know that the 3 banks, right, the earnings announcement is about to come out pretty soon. I believe that is the first week of August. DBS, UOB, DBS, OCBC, UOB. Yes, the Q2 earnings should be pretty fantastic, but what's important is the guidance, the forward guidance right now, given by the management, especially if you look at the current situation in Singapore right now. We start to do this kind of reintroduction of this more stringent measures to curb the current, spike in the local commodity cases. Yeah, even though we didn't lock down fully, but it may impact sentiment. Why? Because, example, you ask yourself, given the current situation now, were you there to go out more often? Were you there to, purchase goods and services? It's a sentiment effect. It's a negative feedback loop. So it may dampen the what I call economic figures when it start to show up towards the end of Q3. But markets are always forward looking. All right. So what is market is anticipating now what will happen in the economic data to come out in Q3. All right. So since we know that the STI is underperforming, we need to look for stocks that are not inside the STI, better still, or stocks that has lower weightage. Even though it's a STI, but it has a lower, maybe slightly lower weightage. So, and even if I look at the current situation right now, perhaps defensive stocks will be a better area for us to focus on in the local, we call Singapore stock market. So if I were to look at, okay, the situation here, Parkway Live Read, okay, all these are screened out through technical uh, screening, technically based on the technical configuration. You look at Parkway Live Read, okay, so what you could see that from the March 2020 low, its uptrend, the major uptrend actually accelerated by the breakout of the former ascending, longer term ascending channel that was in place since October 2018, pardon me, 2018. It broke out, retest the line, and it now shape a further push up. Momentum wise, if you look at the current momentum, right, this is the weekly chart here of Parkway Live Read. It actually broke above a descending resistance linking the former lower high of this momentum. It just did a breakout. Yes, now it's overbought, but it hasn't reached the extreme overbought yet at 83%. That actually coincide with a much more severe pullback over here in their trend. All right. So, and also supported by this 50-week moving average. Okay, so this 50 moving average might be sooner or later come close to $4.40, which is this swing high, this steep swing high, now turns into a pullback support and also the lower boundary of this major ascending channel. Now it's the all-time high already. It hit the all-time high recently. Next resistance level based on the Fibo expansion level. So assuming that this is the start of a new 5-wave up, major 5-wave up, 1, 2, and this is the wave 3. That means talking about much more potentially higher to go. So this is the elliott wave of the fractal approach. Okay, to use technical analysis to actually do a bit of forecasting, not 100%, but based on the principles of elliott wave and fractal analysis to able us to actually more or less have a gauge where is the next potential resistance will be. Potentially, not 100% foolproof, but at least we need to have a gauge. It's a cyclical kind of a method in technical analysis to actually do a bit of forecasting. All right, so $5.20/26, 5.65/70. All right, so this is the technical way of doing forecasting. If we have a resistance level as an all-time high, okay, then those who like fundamental will do the discounting method or something like discounting cash flow. Also similar, also we are doing forecasting of the future dividend payout of Parkway Live Read, similar as well. Everything is just pretty subjective area depending on one's assumption and one's usage of the tool that you analyze. So everything is not foolproof, just based on the probability. But what I could see over here, I use a conjunction of fractal elliott wave together with momentum and trend. So what we could see over here is that there's no exhaustion sign that is topping or is about to crash. Momentum is still positive at this juncture. So all in all is actually support the wave count or the elliott wave bullish structure, we call it the fractal approach. All right, so key support level to hold or maintain this bullish view for this quarter, Q3 will be $4.40. So definitely you look at the trend, is actually much more, it's a very clear uptrend as compared to the STI. All right, so potentially this could actually outperform. Then next one, Riverstone Holdings. This is also I consider defensive because it's related to healthcare equipment. Parkway Life is defensive as well. Okay, it's a healthcare related REIT. All right, Riverstone. So Riverstone over here, right? Ever since hit the low, the 18th of December low at 106, which is actually the 61.8% of the last major uptrend up, the structure up move up from here, 34 cents all the way to 242.45. So this is a kind of a 5-wave up, then ABC corrective move. So this corrective move may have already ended by looking at the strong rebound from the RSI at the oversold level. And recently, the RSI just broken from its corresponding resistance as well. And now it's above 50% and yet to hit the overbought region. So i.e. right, potentially momentum has still not been overstretched yet. So if you look at price action here, potentially it could be tracing close to about 7-month or 6-month plus of double bottom or basing configuration with the neckline resistance at 1.59. So it's a bit slow, slow basing because it's still kind of a basing formation yet, but momentum start to pick up. So potentially perhaps as long as this 1.06 long-term pivotal support holds for this quarter, we may see a push up at least to test the neckline resistance at 1.59. But if we start to see a daily close above it, that means we could actually trigger a further up move to test the previous swing high here that actually kickstart this last down move, which is this very steep fall that we see. Okay, from September, so this is September to October swing high. Every time we hit this last swing high, then after that the pump. So this is also a very key significant resistance level we watch, $2, and psychologically as well. All right, but we're taking one step at a time. Definitely 1.06 level must hold, it cannot break. Then in the first step, potentially to kind of test the neckline resistance of the double bottom at 1.59. All right, now the next one, okay, iFast. So if you look at iFast, the funny thing about iFast is it's more like a tech play. Okay, it's because it's fintech, it's based on the fintech platform. And also, I think there's also some speculation going on, news saying that they're getting a kind of a digital banking license in Hong Kong, which is, I believe, the announcement should be out somewhere around early next year or late this year. Okay, but I look at it from a trend perspective. Okay, so what I did is that I put it in lock over here because if I don't put it in lock, right, the trend is pretty steep. So very hard for me to look at any chart pattern. All right, if we start to do a very steep uptrend. So you look at iFast, right? iFast since the low of 59 cents from 2017 all the way to March 2020, 72 cents, right? So this is like a basing formation. It formed a close to about a 3-year base. Then after from this 3-year base, right, it's just accelerate upwards. All right, so this acceleration of this base over here, right? If I were to look at, hey, because it's pretty steep, so I want to know whether is it backed by earnings or not. This steep up move sometimes it's just purely speculative. So I look at past earnings. This is the earnings growth every quarter. EPS basic earning growth, not diluted. Diluted one is that when they issue new shares, you got to divide by it by number of shares. So this is purely earnings EPS. You look at the EPS, right? Year on year, on every quarter, it has been growing pretty nicely, percentage year on year growth. So this steep up move in price actually back my earnings. Okay, that means that is fundamentally, put away, it's fundamentally back in a way by earnings. It's not like some growth stock, right, that people bet on future earnings growth to be superior. But no, this one here, the earnings has been improving. Okay, so if I look at it, this uptrend is a very clear ascending uptrend channel from the March 2020 low. So I call this the major uptrend, and also supported by this 20-week moving average. Okay, so this 20-week moving average is at $7.05, which is also correspond to the last swing high over here. This was late last year before it just goes sideways and now the steep rally. So 705 as well. This will be my key pivotal support. Okay, then I did a kind of a Fibo expansion from here one time, and corresponding from the start of this long-term secular uptrend after the breakout from this 3-year base, taking from the low of here, project to here, project from the low of here, 4.236. So it actually coincides with this range at $13/1430. So what we could see potentially, right, the next resistance at this level. RSI, nothing. Okay, RSI is hovering around the overbought region. It's still hovering there, but shaping a series of higher low. All right. So it's going to hover at the overbought region. Okay, so my concern is that if it starts to break down below this support line, okay, which I believe is also correspond to the graphical support of 705. Mathematically is by the 20-week moving average. Okay, so as long as this 705 going to hold, potentially the impulsive up structure or this major uptrend is likely or may resume for the next resistance at $13/14.30 potentially, given the current still ongoing positive technical configuration as seen on IFAS. All right. Now the next one, also a kind of a technology stock, nanofilms. Okay, so nanofilm technology, right? Since the IPO price, IPO listing on 30th of October, 2.75, $5.50. Then thereafter, right, it just goes sideways for the close to about 6 months or so, 6 months. So recently now, come to month of January, July, it just broke up from this 7-month base. So they form a 7-month base, and now recently it just starts to break out. All right. So, but we'll be cautious is right now the daily RSI is now coming to the extreme overbought level in the past, which is at 82%. So what it means is that momentum here is strong, but it's a bit overstretched, where we may start to see a bit of pullback towards $6. Maximum it shouldn't surpass 550. So 550 is the key medium-term pivotal support or long-term pivotal support that I have for this quarter to maintain this impulsive upward trajectory movement, potentially to test the next resistance at 680/70. Above it will be the top of this channel for October 2020 low. Now acting as a resistance at 740/55, also a cluster of Fibo expansion level. All right, but we may see a bit of pullback to take shape. All right, so because of the kind of extreme overbought level on the RSI. Okay, so what we could see over here, right, is the current configuration, right, of the STI is more bearish. Okay, I'll put it away that it's mildly bearish, but it hasn't reversed the major uptrend yet. So it may start to do a bit of pullback over here. Then this pullback could last for this quarter. That means lackluster pullback, then just go sideways because of the downward pressure on the top three, the heavy weightage bank, as pressured by the narrowing of the US 10-year, 2-year Treasury yield curve. Okay, so that is the problem. That's the catalyst, right? That is actually causing globally the cyclical stocks not to actually perform that well. Okay, so the next thing over here I want to share with you all is, because right now there's also another key event that's coming out will be Jackson Hole. So Jackson Hole, right, will take place in the last week of August. So what is Jackson Hole? You all can Google what Jackson Hole. Jackson Hole is usually a gathering of US Fed officials, and they may invite other central bankers to Jackson Hole this event. And usually, if there is a change in Federal Reserve policy, the Fed chairman at that point in time will use Jackson Hole symposium or the event to actually signal. Okay, so you all know that there's rumors saying that Powell may start to taper soon, blah, 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 blah. But because the expectation of tempering is pretty high, but don't forget, given the ongoing situation right now that we see worldwide globally, there is what I call this ongoing COVID-19 resurgence of infection cases. It's a mutated one. Powell may not use this conference to actually signal the start of a tempering. It may actually prolong the tempering process, which actually positive for the whole world. All right. So perhaps only at that point in time we may start to see a shift of this cyclical underperformance. All right, but bear in mind over here is that we also have this big event that is coming out in terms of geopolitical risk tension that is building up between US and China. There's lots of incidents going on because right now economic talks are not resuming. The US blacklist on China company continue. That right now China company claim that they are the big data by China big tech firm may be in the hands of certain advisory if they start to list this China big tech firm overseas. All right, so there's this kind of whole hoo-ha about political tension that's building up into place that is not being priced in the market yet. So that may come into Q4. Okay, so we should see how it flows over there. So okay, so to understand about all this thing, right, how to actually, that there's so many things to look out for is you can actually follow me in our social media. Okay, so very quickly, right, before I go into the Q&A, let me share with you all some educational stuff, right, that we have over at CMC. So I urge you, right, you all can just follow me, set up a Twitter account, because Facebook, we don't use Facebook, or Facebook I find it very messy because there's too many news that's flowing around there. Twitter is more straightforward. Okay, so basically what I do is that sign up a Twitter account, then you could follow me at Calvin SC Wong. Just find me and follow me and notify on the notification. So what I do over here is that I tweeted every day on the situation of the market, what's going on in the market, what do I see, all this. All right, from here. Okay, so you can use this as a kind of a educational outlet to actually reinforce your learnings of the markets. And you could definitely, not only me, you can just follow other followers within the fin tweet space, where there are a couple of good followers out there, tweeters out there to actually tweet about the markets. All right, so then for those who want to have a blend of education stuff, that means talking about how to use technical analysis to trade, is subscribe to the YouTube channel. This is CMC Market Singapore. Subscribe it. So if you go to get started in trading, right, if you click on it here, okay, so there is actually a series of trade the markets like a pro. All right, 1 to 10. You can actually find it, 1 to 10. Okay, so this is where I take you step by step how to use technical analysis to trade rather than analyze. It's a different thing. And also, if you could go to this our YouTube channel again as well, if you look at market outlook, so market outlook, right, every start of the week, that means somewhere around Monday afternoon, I will actually broadcast my latest weekly technical outlook, 19 July to 20th of July. Okay, take a look at it. So this week actually I mentioned that the key levels hold on the SPX 4250 and the Nasdaq, those were actually followed. So I'm still expecting a bullish uptrend on the US major indices, but after this uptrend, there might be a multi-week kind of pullback to take shape. All right, so actually you can take a listen at this video to look at to number one is to give you a view of the market, and also I try my best to explain how I look at things. All right, from a technical analysis perspective. Okay, good. So now comes to the Q&A session. Okay, so we have 10 minutes. All right, so do actually type in for Q&A. Okay, so first question, how do I check for fund flow, please? Okay, so fund flow, right? The thing about fund flow over here is it's cost. There's a cost to fund flow. That means you need to have access to various data. Okay, how to put it? Various data provider that provide fund flow data. Okay, so it doesn't come cheap. All right, so Bloomberg, Reuters, yeah, they provide fund flow data. Or what you can do over here is, the only way is you try to look at some of the ETF exchange traded fund provider. They do also provide fund flow data, but on the end of day basis. All right, I hope that answer your question about fund flow. So this is how to get fund flow data. So checking fund flow, yeah, definitely you got to have this data to actually look at the fund flow. Or are you saying that so I believe that this answer your question, is it, for those for the gentleman who actually asked about fund flow, or are you referring to something else? Yes, no, because I try to reiterate your question. So I hope that I am able to answer your fund flow question. Yeah, just feel free to type. So now it's Q&A session. We have some time. Yeah, is there any more questions? Okay, will commodities make a comeback in Q4? Okay, so for Q4, right? Okay, so now commodities prices. So I okay, because Q4 to forecast down the road is a bit tougher for me. So if I look at the current situation now, two things got to be come into perspective. Okay, number one, we do step by step first. The uptrend is still intact for commodities. We talk about oil is still intact. It's one of the commodity price is still intact. Various food prices for commodity is still pretty intact. Copper maybe sideways because of the current situation in China right now. Is they're trying to actually clamp down speculation in copper activity. So copper might be sideways, but oil is still pretty fine. Especially if you look at if this week the 66.6 level or 66.40 level on the WTI managed to hold, which it actually hold last week, yesterday, the day before, it tested and bounced up. So it's positive. So I will say that it's selected commodities. Yeah, oil will make a comeback, but copper maybe sideways. All right. So if I were to yeah, this is the thing. This is my take on commodity prices. Not all will go up in the uptrend. Some may be sideways, some will be up. So the one that is still holding the uptrend is WTI. One thing I may start to look at is gold, because gold is pretty interesting as a safe haven commodity. Because there's a potential escalation of US-China tension coming forward into Q4. uh, that is not currently priced into the market yet. So that could potentially add a bit of a movement in gold. And also, if that geopolitical tensions start to come between US and China, the lesser tendency of Fed to actually temper or even hike its rate so soon will actually lower the real interest rate. All right, so interest rate will be lower, especially the real interest rate. So that could actually benefit gold as well, because gold, if you hold gold, there's holding costs, right, for gold. Yeah, because if real interest rate goes down or maintain at the same level as right now, it could potentially benefit gold, given there's this risk of geopolitical tension in US and China that may start to kind of on the uptick in the later part of this year. That's not being priced into the market. All right, so any opinion on REITs? Okay, so for REITs, right, Singapore REITs, right, I definitely, if you look at the current situation right now, right, for this quarter, I'll be more favored in REITs that are not related to cyclical stuff. Well, like cyclical stuff, we're talking about REITs like more certain more of retail REITs that may not be so potentially good given the current situation. Okay, so REITs I'll be selective because we got to look at certain REITs. So yeah, definitely Parkway Life REIT is one of the healthcare REIT that I'm looking at. So because it's more defensive. Okay, because in terms of it is not linked to the cyclical nature of the Singapore economy. Whereas some REITs are that like more industrial REIT, they may be or highly, I would say in fact they're highly more directly correlated to the cyclical nature of the Singapore economy, where yeah, if this current situation, so-called the semi kind of restriction or semi kind of lockdown keep on persisting, that means we relax, then we go back again. So it may not do well in the next 3 to 6 months in terms of the Singapore economic growth. All right. Any thoughts on golden algae? Okay, so golden algae, right? Well, let me very quickly open up the chart of golden algae. So I just do a chart technically because because golden algae is a chart that I don't follow often. Okay, so everybody can see the screen here. Okay, golden algae. Okay. Okay, so if I were to look at very quickly, right, this chart here, the trend is still down. It's still in a downtrend since 2nd of Jan 2011. If I were to look at it from here, RSI still has some more room to fall. Okay, then the next the support level, right, definitely will be this level here. Okay, it was tested August last year, 13 cents or 14 cents. All right. So, but the key, the risk over here is this, the RSI is pretty bearish, so there is or pretty negative and still has some more room to fall. So i.e. right, we may still see a bearish break of this $14 put. Probably seems to be higher at this juncture. Okay, so that's my take on this golden agri. So there's no change in the trend yet. The trend seems to be is still downtrend since Jan 2011 high, and this support here, yeah, it tested, bounced, but momentum is not strong yet to actually offer a kind of a bullish reversal. And in fact, momentum has started to turn negative, inching downwards, and we may start potentially may see a test of this again, which is 14 cents, and it may break much lower from there. So where is the next support So graphically, right, if I were to look at it, is this level here, 7 cents. So if I were to look at the channel, yeah, it could be much lower, but that's zero idea from there. So this is the trajectory. So it's still bearish. There's no sign of a reversal yet technically. All right. Yeah. So okay. So how about short term? Okay, I gotta answer a couple of questions more. Short term technical rebound for STI Bank instead of down from here. Okay. So what's mean by short term? You talking about intraday or what? So those guys short term. So your short term is like intraday or multi-day, because I got to have your understanding of short term. Uh, weekly. Oh, weekly is still down. Unfortunately, weekly is down. So weekly there's a big risk. So if I could quickly share with you all the banks. Okay, this is DBS. Okay, so DBS group, right? So what we could see over here is this level, this region here. Okay, also the 200-day moving average. RSI is getting pretty weak. There's a pronounced bearish divergence. All right. OCBC. Okay, the support is broken already. So potentially it could fall also to the 200-day moving average. UOB. Maybe somewhere around this level here because of the bearish divergence as well. All right. So next question. Okay. So for some stocks, right, I tried like Gogo Land, also I didn't cover, so it may take a bit of time for me to do. And as well as Hong Kong Land, so I don't cover this as well. So perhaps right, this one just give me a bit of time to actually post over at my Twitter, Gogo Land and Hong Kong Land, because this I don't cover on my frequent basis. So it may give me a bit of time to actually plot the chart because we are running out of time. So a couple of two more questions. How about silver? Silver still big sideway in my quarterly outlook where I share on my silver. Just go through my video in my quarterly Q3 outlook. I have my talk on silver. That is still big sideway. It's a big sideway. What are the views of US and Singapore bonds? Okay, unfortunately, I don't cover Singapore bonds. For US bonds, yes, TLT, we talk about the TLT ETF for longer term bonds, is still positive right now. Why? Because I still reckon that potentially the 10-year yield will potentially there be still more downside pressure. Okay, so from a multi-week perspective, it's still bullish on the TLT. All right, so is the multi-week correction of US happening soon? Okay, so to me, right, I have okay, very quickly, this is the last one. So what I do over here is that in my latest outlook video, which I published this Monday, so I look at this level. Okay, so let me show this level again. Oh, it's a bit slower. at this point in time. Okay, let us start with the. Okay, so this is the pivot that I mentioned. Hit, rebound. This is the level 15,240/300. Okay, a key resistance level. If I start to see a kind of reversal or bearish divergence on the RSI, more or less, we may start to see that multi-week corrective down move Nasdaq. Okay, equivalent level on the S&P. Okay, this bounce 4250 will be 4450/60. Okay, then thereafter, this is a risk level where potentially we may start to see that multi-week corrective decline, but not change in the major trend rate, just a corrective decline. All right, so I hope that you're all able to get a better understanding of the situation on the Singapore stock market in this webinar. I hope that your most importantly over here is to learn a bit something new. That's my ultimate aim from here. So with that, yeah, it's already about slightly 5 minutes or 10 minutes or 7 minutes. A bit of the time for Q&A. So yeah, I'll try my best to pose other questions like what is my technical view of Hong Kong land or GoCo land in my Twitter in the next couple of days. All right. So okay, one more last question. Okay, someone asked me about this. Will Fed be forced to temper given the spread is 10 or 2-year is narrower? Okay, so the Fed tempering, right? All this is all depending on the current situation. Firstly, inflation expectation. Will it be lower? Okay, so how do I understand inflation expectation? You can actually Google what I call 5-year break-even rate that is coming down, slightly coming down, and 10-year break-even rate that's coming down as well. So, and also the situation of the current COVID-19 spread in the system. Okay, so if this thing, the inflation expectation starts to tone down, and the current COVID the current COVID-19 infection rate keep on increasing in the rest of the world, so the Fed they may start to delay tempering, which I foresee. All right. So if that were to happen, we may start to see the 10-year, 2-year start to slope upwards again, start to turn up potentially. Yeah, that's towards the end of the Q3 that we could take a look at it. A bit more time because now the momentum is still down for this compression of this yield curve. They're still pointing downwards. All right. So okay, for Dow Jones, yeah, maybe this one I'll share it in my Twitter because I do not want to drag because now it's exactly 10 minutes. All right, so yes, this webinar is recorded. So once the recording is being done properly, that means I got to filter it. I'll post in my Twitter as well, on my Twitter handle. So the Twitter handle will link it to the CMC YouTube channel. All right, so with that, thank you much for your time and have a great evening and do stay safe. And I see you again in my next webinar. Thank you and have a great evening. Goodbye.